Well, thanks for joining us tonight. How many of you guys would like to find a safe place for your cash, sheltering it from the volatility of the stock market with all the ups and downs? That's what I'm hearing from a lot of you guys as I'm talking to you on the phone. And guess what? That's exactly what we have for you today. The problem is we have too many investors who are trying to make decisions based on what they hear on CNBC or the coffee shop, and they're not aware of the alternative options for short or medium term options where they could place their cash that pay dividends that are higher than a CD or just a money market account. And that's certainly not your fault. After putting in the long hours, most of you guys have full time, busy careers or running a business. A few of you have got the time to dive in deep to the alternative investments to find the few gems that really pay out. So we've scoured the universe. There's three of us full time in investment committee. This is what we do, and I'm going to show you how to fix that problem. So we're going to go through a number of case studies today, none of which are really to be interpreted as a type of income claim, implied or otherwise. So we'll share some confidential information with you tonight. Feel free to share that with your investment advisory team. Any type of investing involves a degree of risk, so you'll want to use your investing team to help you assess the risk, see if it's a good fit for you and your family. Nothing in today's discussion will be an offering of an investment. If you want to learn more, we're delighted to share all the legal documents with you, and then your investment team can help you evaluate those in the proper detail. There'll be a lot of forward-looking statements. You're going to hear me say may, will, plan, expect, seek, anticipate. This is all based on the due diligence that we've done, information that we've gotten from our sponsors, our assessment of the market. You'll, of course, want to do all those same analyses on your own to come up with your own ideas. And there's a lot of company source information, and you'll want to do your own research. So in short, your results are up to you. I can't predict them. So if anyone says they can predict them, they're either lying to you or else it's a guaranteed account like a CD at a bank and it's going to pay such a low amount. It's probably not what you guys are seeking. So I'll show you how we analyze the numbers and what's working for myself and a lot of our investors. And then you can hopefully decide if it's a good fit for you as well. So, who are we? Why should you listen to us? Here's the three people on the investment committee. I worked as a strategy consultant for 8 years at Deloitte and Accenture, and I've been in commercial real estate full time for about 2 decades now, a little over. Built a large brokerage where I got to watch thousands of transactions each year, hundreds of which were investors, and learn a lot of what worked and didn't work from them. Plus, I've done a couple hundred transactions on my own. Brent Geyer is our CEO, did a lot of real estate acquisition, land development work over the last couple of decades, done over $1 billion of transactions, and was at KPMG as a CPA before all that. And Richard Landry comes to us via Goldman Sachs, and he was the chief investment officer for a $2 billion family office, among other roles before joining us. So the three of us had the luxury full time of just thinking about these sorts of problems for you. So our goal is to find diversification in the investment portfolio so we can get away from some of the risk and give you guys better results. So I want to talk a little bit about the finance theory of this, and this isn't going to be like a graduate level finance class, but I want to spend a little time on the finance theory that underpins what it is that we do. So the guy in the middle here, his name is Harry Markowitz. He won the Nobel Prize in Economics in 1990 for developing a paper, Modern Portfolio Theory, and a lot of contemporary finance is built on the shoulders of what this guy figured out for us. He's really the one who figured out the concept of diversification and overall portfolio risk and return. And he was able to show there's an optimal risk and return profile in a portfolio of assets, and it depends on the correlations of the assets within the basket against one another. And I'm going to explain correlation to you in, I hope, a relatively simple manner. And once you grasp it, I think you're going to really have a good handle on this really powerful concept. So he's one of the heroes of the finance industry as a result of this conceptual breakthrough. So if you think about the relationship between risk and reward or return, on the x-axis on the bottom, you've got from low to high volatility, and on the y-axis going up and down, you've got from low to high return. And I think the way most people tend to think about this is that low risk, low return. So I'm going to put the money in a CD at a bank. High risk, high return. Maybe I'm going to invest in platinum futures. And there's sort of like a linear relationship between these. As you take on more risk, more volatility, you'll be rewarded with more return. Well, that's generally true, but if you construct the portfolio in the right way, you can actually do a little bit better than that. So one of the ways you could do this is say, I want to have a fixed amount of return, but build a good portfolio to get that same return, but have less risk. That's one of the tools that Markowitz developed with his portfolio theory. Another way to think about it is that I'm comfortable with this level of risk, but I want to go from a relatively low amount of return to a higher amount of return, but keep my risk profile relatively the same. And if I buy the right choice of assets with the right types of correlations, I can build a portfolio that should be able to do that. So Markowitz got the Nobel Prize because he proved that adding non-correlated assets can increase the returns while actually keeping the risk the same or slightly reducing it. So correlation is really the thing that underpins all this. And correlation is just a fancy word from your statistics class saying how likely is it that two securities prices or values move together in sync, or do they move in very, very different sorts of patterns? So correlation is measured from a +1, which is perfectly correlated, to a -1, which means they're completely not correlated whatsoever, or a 0 means there's just no relationship. And usually 0 is really kind of what we're looking for. So imagine you've got security A in the light blue, security B in the dark blue. So maybe one's Amazon and one is Google. Uh, these two securities on this sample graph here, they move perfectly in tandem all the time. So their correlation would be 1.0. It's a perfect correlation. These two securities always move in the exact opposite direction, in the exact opposite magnitude. So they're exactly not correlated. So their correlation coefficient would be a -1. It's perfectly non-correlated. And in real life, it's very close to impossible to find two assets that really behave in that manner. Oh, did I lose a page here? Okay, I guess I thought I had one more slide in here before we make this jump. So our goal is to get assets that have got as close to a zero correlation as we possibly can. And I apologize, I thought I had a different set of slides that here. Here we go. Here it is. So if you've got two slides that are negatively correlated, maybe you've got one company in the black line, and all they do is make coats and umbrellas and other things that you'd want to have on really rainy days. And the light blue line is all the things you need to go to the beach, beach towels and umbrellas for keeping you out of the sun and sunscreen. And the demand for those products would be perfectly out of sync from one another. And if you had a diversified portfolio that would smooth them out between the highs and the lows of the different securities that were in there. So that probably sounds really good. The challenge is that there's a lot of different asset classes, and the typical return for any one given asset class varies an awful lot each year. And just keeping track of all this could be a full-time job for you. So most of the publicly traded stocks and bonds, I'll show you the bonds on the next page, have a high degree of correlation. So if you take a look at this first column on the left, large companies, if you compare the performance of stock prices of large companies to medium-sized companies, you see it's a 0.92. It's almost perfectly correlated. So medium-sized company stocks move just about the same way that large company stocks do. Small company stocks are a zero 0.9, so just about the same. International is 0.87. And even if you just look at the really small companies that are just getting out of startup, it's still a zero 0.7. So what this tells us is that there's not a lot of diversification that you accomplish in your portfolio if you take your money and spread it across these different types of equities of large, medium, small, international companies. They're all going to roughly go up and down about the same at the same time. So that diversification doesn't drain a lot of risk out of your portfolio. So what does tend to be not correlated is private equity. And when you take a look at institutional capital, you can see about 19% of the $135 trillion globally in institutional capital is allocated to private equity. And the rest is traditional types of stocks and bonds and things like that. So if you look at so institutional capital, what does that mean? That's largely pension funds, endowments for large universities, the sponsored structured retirement programs for like, Exxon. Those are, multi-billion dollar institutions that have got very sophisticated financial teams that run them. If you take a look at private wealth, so this might be someone with, say, $100 million worth of net worth, and he's got one person running his family office. It's a much smaller team, and you can see the allocation to private equity really gets a lot smaller. It gets down to about 3%. And you might ask, well, why is that? Lack of access is part of it, but the biggest obstacle is the high minimum investment. One of the favorite investments that we've made at Ironton is with a group called Hill Point. We've got some solo Hill Point funds, and it's a component of a lot of our long-term diversified funds. And Hill Point's minimum is $3 million. So even if you're someone who's pretty affluent with, like, say, a $30 million net worth, to put $3 million into just one investment is like way too much. So the high minimums tend to scare away individual investors, family offices, and these only tend to be of a size that makes sense to someone who's running, say, a $10 billion fund. And for them to make a $3 million investment is no big deal. That's sort of like almost a rounding error to them. The complicated tax strategies on the lack of reporting, or less frequent reporting than the public companies, are other obstacles as to why we don't see most people investing in private equity. So let me see if I can show you the correlations here. So what kind of correlations do we have between the large stocks and some of the private equity investments? So if you take a look in this first column on the left, you can see that commodities are only a 0.28 correlation to large stocks, so it's very small. Venture capital is 0.45. Private real estate, which is most of what we do, is 0.3. Private infrastructure would be like, say, toll roads. If you live in the Denver metro area, the 470 loop is financed by people like us. There's not a whole lot of correlation between what happens to stock market returns and the returns provided by a toll road around the periphery of greater metro Denver. So those are not correlated assets. So those are the types of things that we want to look for, things that have a very low degree of correlation. And that's how we build a portfolio that achieves what Markowitz talked about. We want to get good, solid returns and drain as much risk away as we possibly can. So I'm going to pause there, as I went through a lot in a hurry, and see if you guys have any questions.
Yeah, guys, feel free to send over your questions as you come up with them. We are more than happy to address them as we go throughout the presentation.
So one thing I'll just say while you guys are typing your questions in the box there is, if you take a look in the upper left, the correlation between large company stocks and government bonds is actually slightly negative. So that's really, really good. And historically speaking, you'll see that a lot of people have got a portfolio built of, say, 60 or 70% stocks, 30 or 40% bonds. And the reason for that is that these two together, they're like peanut butter and jelly. You get a good return that's pretty stable. In recessions, it doesn't go down nearly as much. In good times, it doesn't go up quite as much, but it's really, really steady over the very long haul. So if you've got bonds in your portfolio, or if that's been recommended to you by your financial planner, that's probably why. It's a really intelligent addition to go with stocks.
No questions so far, Lon. So maybe we can keep moving through.
Okay, so I'll talk a little bit about private equity returns just briefly for you. On this chart, the dark blue line, it's going to be the one on the left for each of the time series, shows you global private equity net internal rate of return. So that's after all fees and expenses. On the right-hand side, the light blue line is the global stock market rate of return. And you can see that the private equity has outperformed the stock market any way that you want to look at it on a 5 to 35-year horizon. So it's one of the reasons why the big institutional guys like to use things like that. So I'm going to just stop with that. I apologize, our slides are just a little bit out of order here. Do you want to talk a little bit about MTI?
Yes, this is a perfect segue into MTI. So MTI is our medium-term income fund. So this is an executive summary here, guys. Some of you on this presentation may be familiar. A lot of you that are new to this presentation, this might be a fairly new concept. But the reason we're getting to this point is we want to really highlight that there is a significant lack of correlation behind the medium-term income fund, the performance of that fund, and of course the stock market and the real estate market. So what is this investment all about? And Roger, great question. We'll get to that as soon as I get through this slide. So in essence, what we're doing with the medium-term income fund, the fund is backed by a portfolio of medical accounts receivables. And so what we're doing is we're providing financing solutions to physician clinics, hospitals that have a high patient volume of those who have been injured in car accidents. Inevitably, what happens is the physician's office, the clinic, or the hospital, as they're waiting for a lot of these claims to pay out, which can take anywhere from 4 months all the way up to 3 to 4 years for these claims to inevitably pay out. The clinics and the hospitals, they're waiting for these claims to pay out so that they can eventually get paid for the services and the treatment that they are providing to these patients who have been injured in car accidents. So, as you might imagine, if you're waiting 4 months to anywhere up from 3 to 4 years, you could end up with a very large and ever-growing stack of unpaid receivables. And so that creates quite a problem for the physician's office and the clinic and the hospital, is that I need to keep the lights on. I need to pay my staff. I need to pay the lease. I've got all these other expenses that I'm responsible for. And I've got this huge stack of paperwork that needs to be, where these claims need to be filled out. And on top of that, I'm paying somebody to go back and forth with the insurer just to complete the documentation and handle all the administrative burden that comes with it. So what happens is we come in with the sponsor that we've partnered with for the medium-term income fund, and we're either going to advance a line of credit against those receivables so we can solve the cash flow problem for that office and give them payment today, or we'll buy that stack of paper at a significant discount and then accept the payment from the insurer. So there's a problem, there's a solution, and then there's what this fund offers, which is that solution. And so we'll get into a slide that goes into that a little bit more, but that's the essence of the medium-term income fund. We're providing a solution in which the problem is a cash flow constraint at the physician level in their office. So the fund delivers about 11 to 13% a year. That is dependent on your total assets under management across all of Ironton Capital. It does pay quarterly, and the payments come usually the week of the 15th following the end of the previous quarter. We've been able to distribute that exact week every single quarter. So 11 to 13% a year, quarterly dividends. All we ask from investors is a 1-year lockup of capital. Once that year's up, you can redeem your capital, or you can continue to add to your balance and generate more passive income for your portfolio.
So the thing that we really like about this, and I'll show you the details in a second, but the punchline is that the returns from the medium-term income fund are not correlated to the stock market. So they perform in really the same capacity as a bond, not being correlated to the stock market. But bonds might pay 3%, 5%, and we're going to be able to pay 11 to 13. So we can bring you a lot more return to the overall portfolio and still reduce the risks, just like a traditional bond would.
It's a good question from Roger. Explain the difference between venture capital and real estate equity.
Yes. So venture capital is when you need to have equity to start up a company that's relatively high risk, high reward. There's no liquidity, and the money will be tied up from 5 to maybe as long as 10 years. So some of the guys who are Ironton limited partners invested in a project with me called Momenta, which is a technology company that's about 7 years into their life cycle. So providing equity to someone like that is called venture capital. What we do in real estate is somewhat similar on the long-term fund, where we're providing capital to someone who's going to build a new apartment complex like Hill Point, or do a heavy renovation of an existing apartment facility. And it might take us 3 to 5 years before we get the money back, and there's no liquidity to it. What's different about it for us is that when you're starting a new tech company, it's kind of an unknown as to whether or not there's going to be demand for the product or not. You're just kind of going on, wow, that sounds like a really good hypothesis of what they're going to do. It looks like the market's really big. We see there's a problem that needs to be solved. This management team has experience that's related to solving that problem in the past. I'm going to bet on this. As opposed to, I can go to a suburb of Charlotte, South Carolina or North Carolina, and see that there's a supply-demand imbalance for extended stay hotels within a 5-mile radius of this intersection on the interstate. And the only 2 competitors I've got in that submarket are both 10 and 20 years old. And I'm going to put a brand new hotel there because there's demand for it. I'm going to steal market share from the other 2 guys. The risk reward profile of what we do on private equity on the real estate side is it's a lot less risk and a lot less reward. If you invested in Google before they went public, you probably became a multimillionaire. Our returns aren't going to be as impressive, but we're trying to take a lot less risk.
And question from Jonathan: what are the major risks with the MTI Medical Fund?
So the biggest risk is that it's a fraudulent claim. So what we like to do is have a basket with about 100 different small claims in it. Our typical size is around $30,000. We'd like to advance about a third, or about, say, 10,000 on average. And if the claim is, they accept the claim, but they say, look, we're not going to pay 30,000, we're only going to pay 20,000. Well, we only paid 10,000 to the physician, so we still are going to make a pretty decent profit on it. But if one of them comes back saying it's fraudulent, that's not a problem. We've got 100 of these claims from one clinic or one physician, and they're all cross-collateralized. So if two of them don't pay out, which is kind of what I would expect in a typical basket of 100, I've got 98 other claims that I can go after to go get paid. Another type of risk is that most of our counterparties are Geico, State Farm, Allstate, Colossus, AAA insurance companies. So very little danger of them going out of business, but not all of them. There's some very, very tiny ones in there as well. So if we've got like a very small insurance company as our counterparty and they were to go bankrupt, even though our claim is valid, we may not get paid. So that happens very infrequently, but you might get one per basket. And again, you've got 98 other in the basket to go after to get paid. I think those are the biggest ones. Yeah, I think a further risk is that the guy that started this fund up is a genius, and he's made so much money. I can't imagine that he's going to work for forever. His operational team underneath him does all the operations. So if he got hit by a bus tomorrow, it'd all be fine for us. The fund would run okay. There just wouldn't be another fund. That's I think actually our biggest risk of all is that this is probably going to be the last one.
How established are the medical companies?
I think it's all over the map from 15 to 20 years. And if the hospital is a counterparty, it could be as much as a century. And then the other counterparty, of course, will be the insurance company. So the vast majority of the time is going to be Geico, State Farm, Allstate, someone's like probably a century in the business. But you never know. You might have like a really small insurance company that's only been around for 5 years and they're not that well capitalized. Those are the ones probably at risk of default. So the vast majority of our counterparties are pretty stable. We don't have any recourse to the physicians. We're buying the claim from them, they get paid, and then they're out of the picture. So really our counterparty risk is the insurance company. Great questions.
So a lot of common question that we'll get, and I know you can provide a good answer for this, is a lot of times when people hear this concept for the first time, they think, well, is this because patients aren't paying their medical bills? But that's actually not the case. This is not consumer unpaid medical bills. This is a direct interface with the insurance companies such as the Geicos, the State Farms, the Allstates of the world.
Yep.
They're going to pay out. It's a function of what percentage of that typical face value they're going to pay out. Maybe it's 60%, maybe it's 80%, but they're going to pay out. So really it's to that point, again, some of the questions we get is that exact question. And I'm pretty quick to turn it back over and say, like, this is a direct interface with the insurance company. So we're not concerned if patient A or patient B does not pay their medical claims. That has nothing to do with us.
No, we're never collecting from a consumer, and you don't want to collect from consumers because they can complain to the state regulator or a state legislature, and then they could change the rules. And we don't want that. We're only collecting from insurance companies because that's what they're in the business of doing, is paying claims.
So why isn't everyone doing this? Question Roger asked.
So the real thing here is that if you're just buying a receivable, that's called factoring. So you can do factoring on any type of receivable that you can dream up. And it's a very well-established business. There's lots of banks that actually just specialize in being factoring agents. What's different about our co-sponsor on this, PFD, is that they take over all of the paperwork in the billing process so that the physician or the clinic no longer have to deal with all the paperwork process. So really what they're buying from us is these small nuisance files that aren't worth their time. We take over all the headache and the paperwork and overhead. They get paid today and they can just forget about it. So it's the process that we've built is really the service that we're selling, and the factoring is sort of the ancillary to it. If it was just factoring, then we would just be like in a knife fight with a bunch of banks and like no one would make any real money with it. It's a very small niche, but it's a great one.
That's a really key point because there's really the burden of the admin and the paperwork that the clinic is able to outsource and send our way. So that's a key thing here. Like, a bank is never going to take over that. Even if they could provide the financing solution to that clinic against the receivables, they're never going to take over that paperwork burden. So instead of the office paying another staff member to do that, they can just outsource the entire process, write it off their books, and move on with their day and continue treating the patients that they signed up for in the first place, not constantly going back and forth with health, insurance companies trying to figure out what they missed, on their paperwork. They send it our way and we complete it.
Yep, that's it.
So
go ahead.
Yes, Jonathan. So it's not from legal settlements, but from insurance.
Yeah, so if you imagine that Nick and I get into a car accident, Nick's with Geico and I'm with Allstate, and I'm gonna blame Nick. He's at fault. There's like a bundle of things that need to happen, right? I've got a neck injury, so I need to get medical treatment to get well after the accident. My car's been totaled. I need a new car, and then maybe I think I should get paid pain and suffering as well. So there's like three different things that could be more than that even could be involved in the insurance settlement between our two insurance companies. We're only concerned about the medical component about us. That's the one that's the hardest to argue about. um, I don't know how much pain and suffering should be. We'll let the attorneys figure all that stuff out. I'm not an attorney. I just wanted like, you know, my bill added up to $30,000, and I'm going to give you like $11,000 today for it, and you don't have to fight with it.
Awesome. Great questions, guys. That was the last question in this batch long. So if you wanted to continue forward.
Cool. All right. So let's take a quick look here. What I want to show you is just a couple charts showing you the correlation. So if you take a look on the left-hand side, this would be the value of a $100 investment in the medium-term income fund 20 years ago. So summer of 2005. And I think I put it in here at 11% compounding over that whole time period. So it's a nice smooth curve over all the years. And then if you take a look at the orange line, that's the S&P 500 index. So your $100 investment over the 20-year period for MTI, it grew to almost 900. To S&P index, it grew to a little over $500. So both were really excellent returns, but you can see there's a lot more volatility on the left-hand side when you take a look at the stock market. The right-hand side just shows you the same returns, but on a quarter by quarter basis. And you can see, this is what makes the stock market so exciting. It's up and down and up and down and up and down. And on average, it blends out to a pretty decent return. But there's an awful lot of bumps along the way. This slide is exactly the same thing, but I'm just doing a 10-year view instead of a 20-year view. And I wanted to pick this because the last 10 years for the stock market have been pretty great. So a $100 investment 10 years ago, so this would have been at the beginning of 2015, the stock market grew from 100 to 301, and MTI grew from 100 to 302. So almost exactly the same return as the stock market. But again, if you look on the right-hand side, you can see the quarterly returns for the S&P 500, the broad stock market index. It's kind of gut churning, at least some of the time, and we can drain a lot of that out of there. So if you take a look at the correlation between these returns of the stock market each quarter and MTI each quarter, the correlation is 0.01. So it's almost perfectly not correlated. And if you remember about that Nobel Prize winning theory that we opened with tonight, our goal is if we can invest in a basket of assets that are not correlated with each other, we can increase the return and reduce the risk. And that's why MTI is an important part of the portfolio. So let's take a look at this compared to the bond market. So earlier we talked about how bonds are not correlated to the stock market and why it's been a great tradition for decades and decades for people to have stocks and bonds together in their portfolio because it drains the overall risk and keeps pretty good returns. And if you have to take a little bit out every quarter to live on in your retirement, during a recession, if the stock market goes down, you don't want to like burn through your portfolio. You just probably go through your bonds instead during that time period. So they're very complementary. Very similar story here with MTI. So if you take a look at the bond market, you can see the volatility is so much less than it is with the stock market, but the returns are a lot less as well. So if you put $100 into AGG, the aggregate bond index, 20 years ago, it about doubled in value versus MTI went up ninefold. If you take a look at the volatility, it's a lot less than the stock market. What's the correlation between these two? Zero. Like it's perfectly non-correlated. Exact same information. This time we're just doing the 10-year view instead of the 20-year view. And you can see that the bond market is nice and slow and steady, throws off lots of great dividends, and it's correlation of 0.02. So some investors I talk to, they want to see 10 years, some want to see 20. So I put them both in here just depending on your preference. You've got both charts to take a look at. We talked about those. Do you want to talk about the mistakes or should I?
You got it.
So when you take a look at investors and ask why are they not getting the returns they deserve to get, these are the common problems that they tend to make. They jump between asset classes trying to time the market, and there's been lots of academic studies showing that it's almost impossible to do market timing consistently over time. A lot of people will tend to over concentrate into a single asset class. They may only have like 2 or 3 stock options, 2 or 3 bond options in their IRA set of choices they can pick from. So they just put it all in the S&P 500. They don't diversify enough across geography, strategy, sector, asset lifecycle. If you can get some intelligent diversification, you can maintain returns but take the risk down. They may not have a clear overall investment strategy. So I imagine, hopefully, a lot of you guys do have an investment advisor helping you out. Making investments because you can, not necessarily because they are the right investment, and then underallocating to private assets.
Well, I got a question, and I can answer this one. So, Roger, what do I get? Distributions, interest, or return on principal? What are the tax implications? Yeah, so you invest, let's say, for example, $100,000. The interest there's a two components of the medium-term income fund. There's a interest-only period, which lasts from inception of the fund, so that's July of 2024, all the way through June of 2031. So it's a 7-year interest-only period in which you can redeem capital or add to your balance. And you can continue doing either one of those things all the way until 2031, so long as you've met your 1-year lockup period. The second component of the 10-year fund is a amortization period which starts in June 2031 and goes all the way until 2034 of June, in which you're now going to be receiving interest plus principal. So each quarterly payment is going to be a further reduction of your principal until it's all paid back at the end of 2034. So the initial 7-year period, it's all interest only. Your principal remains the same. If you invest $100,000, there's no fluctuation in value of your principal. It remains $100,000, except now you're getting interest only payments every quarter on that principal amount. And then once that second component of the 10-year fund hits, so 2031 to 2034, that's when you start to see interest plus the principal reduction in amortization until it's a full payout by 2034. Now, the tax implications always, anything tax related, definitely confirm with your CPA, but any distributions in the interest only period is typically taxed at your ordinary income tax rate. So if you're a very high tax bracket, maybe you're a physician, attorney, or you're an agent and you're making a bunch of money and you're well above that 35% tax bracket, you'll be making great income here, but it's not going to be as tax efficient. So you'll want to really look at things from an after-tax standpoint on the return. We're not talking about it here, but the short-term income fund we have, that is has a more favorable tax designation. It's taxed as a REIT, but the returns are lower. So your net after tax will still probably be lower anyway. So those are the tax implications, and that's how the fund's structured from a distribution standpoint. Robert's asking, how long has IC been investing in MTI? Is there a long enough history of returns that match your 10 to 13% projections?
So we've been with them for about 18 months. Richard Landry, one of the 3 guys on the investment committee, worked with them before he joined us. So he's got a much deeper, longer relationship with them. And he's the one who brought the idea to us. We were able to reestablish, or rather establish a relationship with them once we started here.
Yep.
Great question.
Yep. And yes, we have been hitting those returns. Again, it's a fixed rate of return that depends on your assets under management. So when we say 11 to 13, what that really means is if you're sub 100,000 in assets under management, you're getting 11%. If you surpass that threshold all the way up to 499,000, you get 11.5%. And then it's 12 from $500,000 to 999,000. And then it goes up from there as your AUM scales up until 13%. So it's a fixed rate of return that depends on your assets under management. I think we have a breakdown. And I believe since inception of, we have we have MTI 1 and 2. Since inception, we've sent out close to 3 million in distributions to investors in that time period.
Super. So, we went through some institutional best practices, and there's 5 of them here. You guys have probably already read these that we can help you out with. And then the things that are kind of in your control is, build a plan and stick to it. Don't let emotion get in the way. Don't follow the investment fads that you see on CNBC, and it'll take a lot of risk out of your portfolio just from that. So I think we talked about how we do all this. Did you go through this slide yet?
Not yet. So just a little bit of detail on the sponsor. Again, the sponsors, they've been in this business for a long time, really since 2012. So they've collectively, the executive team, they've got over 20 years of experience in the medical industry, private and public companies, research and development, alternative financing. So they've got a very impressive track record. So they've been in this business for a while. Before they really got into the financing aspect of it, they were the company that the clinics would outsource all the paperwork to. So they've got a very deep experience in the admin and the paperwork side of the equation. And they've also got close to a decade of experience with the actual fund and the financing aspect of it as well. So they launched their first fund in 2017. Never lost principal, never missed a distribution. And our Ironton fund continues to track at that same progress with this fund as well.
Perfect. Oops, slide here. So what are the comparisons if you don't use the short-term income fund or the medium-term income fund? Here's some rates I got for savings accounts when I looked a couple days ago. So they're in the 4 to 4.5% range. Do you want to talk about how STI works?
Yeah, so the short-term income fund is so as you can see in the fourth bullet point there, you're going to have a large exposure to real estate, right? So what we're seeing in the residential market, a bit of a downturn and a shift in the real estate market as a whole, and so therefore the short-term income fund is susceptible to the fluctuations of the real estate market, particularly here in Denver and Salt Lake City. So the real estate allocation, it's a hard money loan fund. So we're originating loans to investors in Denver and Salt Lake City who want to buy a distressed property, renovate it, and sell it at market rate. So they're fix and flippers. The other 20% of the fund is the medical receivable. So it's a diversified fund across real estate, most exposure to real estate, but they've got this uncorrelated component of the short-term income fund, which is invested in the medical receivables as well. So the benefit to the short-term income fund, as you can see, it's a lower rate of return, 8 to 9%. But for you investors who want to park cash and you need just a little bit more of a rapid form of liquidity, the short-term income fund is a great bet for you. So whereas with the medium-term income fund, you need to give us a 3-month notice, and it will take the 3 months for us to get that capital out. With the short-term income fund, we just ask for a 30-day notice, and in many occasions, we can get that money out in less than that. While it's not an ATM, it definitely offers more of the liquidity benefit that our medium-term income fund can't quite offer. There's also no lockup of capital that's required in the short-term income fund. So a great place to park cash, and you're still going to get double the returns you're going to be getting in a high-yield savings account. And most people don't need liquidity like that. If you do, keep the money in your high-yield savings account. But if you need a little bit better liquidity than a medium-term income fund can offer, then the short-term income fund offers a great solution to that liquidity factor. Additionally, it is taxed at a lower REIT tax rate, so you're not going to get hit at your ordinary income tax if you're in a very high income tax bracket. So this is more of a tax-efficient income solution for you investors as well.
What I found when I still owned a lot of commercial buildings just directly, I had savings accounts with each of them where I was saving up money for roof replacement or elevator replacements or boiler overhauls. And they're all things I knew that were going to happen, but it wasn't clear to me like when I was going to have to spend the money. But I wouldn't want to wait a year to have to get it out, like if I had to like overhaul a boiler. So STI paired with like a commercial asset where you've got money set aside for that type of repair budget, it's just a really great combination.
Roger is asking, do you have good communications with the management, and are they responsive to your questions?
Yeah, both our partner on the short-term fund, Indicate, and our medium-term fund, which is PFD, are phenomenal. We visit both of those guys multiple times a year in person, have great relationships. So yeah, absolutely, much better than on the long-term investment side, where sometimes it's really hard to get these guys on the phone. So just a quick comparison, if you are investing at 3% in a savings account, and you're in a marginal tax rate of 39%, your after-tax return is 1.8%. So if you put $100,000 in there for a decade, it would grow to about $119,000 after tax. As opposed to if you took the same money and put it in the short-term income fund and you got 8%, but it's taxed as a REIT, a real estate investment trust. So your local and I'm sorry, your state and federal might be 23% blended. So your after-tax return is 6.1. Your 100 grand is going to grow to 180. So it's about 4 times the amount of return, 80,000 versus 19,000. So for a highly liquid account, that's some of the things that we really like about STI. What if you can, set money aside for at least a year? Then, 1-year certificate of deposit at your bank might be an attractive alternative. So here were the best ones I was able to find on the internet a couple days ago: 4.2, 4.4%, kind of in that range, as opposed to medium-term income is in the 11 to 13% range. So quite a lot more return to work with there. Did you want to go through our historical returns? I think maybe you already did this, Nick, but just to
Yeah.
recap.
Yeah, so the MTI 1 and 2, these are very straightforward. It's not going to fluctuate much. Again, it depends on your AUM, and whatever your AUM bracket is the fixed rate of return that you get. Now, the short-term income fund 1 and 2 here, we have been between the 7.5% to 8.5% overall IRR. It will fluctuate more. There's more seasonality, performance that's associated with the hard money loan funds. You might have some quarters where the performance is higher than others, whereas that's not the case with the medium-term income fund. But so far, in both funds, we have maintained the rate of return right within those ranges you're seeing present there.
Going pretty well.
Now, one quick question just on that one, Lon, just something to address. So sometimes folks will see STI 1, STI 2, MTI 1, MTI 2, and wonder what the differences are. STI 1 and 2, there's really STI 2 has the medical receivables allocation, but the biggest difference, what really led us from STI 1 to 2 was the SEC limits you to about 99 investors in a fund. And so once we hit that cap, we came into STI 2. So really, it's a very similar structure, as is MTI 1 and 2. MTI 1, we had a smaller allocation with the sponsor, very quickly raised that money and hit our allocation. And then we went back to the sponsor and said, look, there's a huge demand for this product. Can we structure something a little bit more favorably, not only from a liquidity standpoint, but also just a longer duration so that we can offer our investors a product that will last longer and present more of an evergreen option to them. And so we did that with MTI 2. So whereas MTI 1 is only about a 3 to 5 year fund, MTI 2 is a 10-year fund, and it gives you guys the availability to continue to fund the investment. It also gives you a bit broader diversification across the whole portfolio. So MTI 1 is closed, as is STI 1. MTI 2 and STI 2, those are both are open and will be so throughout from the remainder of this year and into next year through 2031.
Very good. So something I'm always happy to do for any of you guys, if you want us to, is do a study of a rental property that you currently own today. And I only need a couple data points, and I'll show you what those are here in just a second. And what we can do is show you the amount of wealth generation that you would get from holding onto that rental property over the next decade. Or if you were to sell it, and look at, say, the stock market, the short-term fund, the medium-term fund, our long-term investment fund, what sort of wealth creation could we generate for your family under those different scenarios? And then we can give you all the facts that your family needs to make a well-informed business decision about what to do next. So I'll show you a quick case study. This is one that we actually did for one of our investors. So they had a couple of rental properties, Wheeling and Lansing. They had about 1.3 million worth of equity in it. And we estimated that the appreciation on this would be about 3% per year. So it's about $43,000 a year. And the cash flow they were enjoying from the property was just under $50,000 a year. So the total return, in simple terms, is the appreciation over time and the cash flow, which is about $91,000 a year. In addition to that, there would be a tiny amount of principal pay down each year. I'm omitting that just for simplification. And there's some tax benefits from using depreciation to shield your taxes. That would make this analysis a lot more complicated. So just to simplify that, I just looked at the two cash flow drivers that bring the vast majority of the returns for most investors. So they had about $330,000 invested to buy these properties. They bought them quite a long time ago, back in 2009. If you recall, the market crashed in 2007, hit bottom in 2009, and started going up after that, so that they couldn't have bought these at a better time. So I did a quick analysis just to estimate what would the capital gains liability be if they were to sell these guys, not do a 1031 exchange, and go ahead and just pay the taxes. And the quick answer is about $260,000 of taxes would be due on the $1.1 million profit. So pretty good deal right there. So what would happen if we did nothing? So if you take a look at this blue box, we've got $1.3 million of equity today, and we calculated that it's a 6.9% return. So let me just show you one more time where that came from. We have got the appreciation of 3%, that's 42,000. We've got the cash flow of 49,000. So our total return is $91,000. And we've got 1.3 million of equity. So if we just take this return of 91,000 divided into the equity of 1.3 million, that's where that 6.9 or 7.0% annual return comes from. Does that make sense? So if we take their current equity of 1.3 million and grow that at 7% a year, over 10 years, it's going to more than double. It'll become $2.6 million for this family over the next decade if all they do is keep those 2 rentals and just keep grinding it out. So what if instead we decide to sell them off? So one option is we could put it in the stock market. That's the option all the way on the left. So we'd start with 1.3 million of equity. We'd have about 50,000 of transaction costs for broker commissions, title fees, some other escrow fees. We'd have that capital gains tax of $250,000. So instead of $1.3 million to invest, after all the expenses, we'd have about 1.0 million to invest. And if we look at a typical stock and bond portfolio, which is what most people do, if we look at those returns over the last 50 years, on average, it's been a little bit over 8% per year. So this portfolio would grow to be 2.12 million over the next decade. And you'd have the advantage of it being very liquid, and you could change how you invest it whenever you wanted. So doing nothing is 2.6 million. The stock market is just about 2.2 million. So not quite as good a return in the stock market, but it's very close. And if you're annoyed by having to deal with the tenants and the other issues, this gets you out of that. Another option is we could sell the 2 properties and put it in the medium-term income fund. And that's our middle orange case here. So we start with 1.3 million. We've got the same transaction costs, the same capital gains. We get to invest the same million as we would in the stock market, but we'd be getting a 12% return instead of 8. And it's only 4 more percentage points, but it's amazing. Over 10 years of compounding, this will grow to $3.1 million. So for this particular family situation, they would actually make more money by selling today, paying the taxes and not dealing with the tenants and all the headaches ever again, putting it on autopilot with us, and they'd actually come out $600,000 ahead. So that was like a real eye opener. A third option, which is kind of out of scope for today's discussion, I'll just show it to you briefly, but we've got a separate presentation on this, is they could put it in our long-term fund, the National Diversified Fund, and that's between the orange and the blue. So there we'd have the same transaction cost to sell, but the capital gains tax would be less because the long-term fund can give you depreciation to offset your capital gains. Not enough in this case to wipe them out because there's so many gains, but it can make a really good dent in it. Our target there is 17% a year, and then that grows to $5.2 million, a little bit more than double. So if you'd like to have me do this analysis for you, Nick and I'd be happy to do that. All we need to get from you is the address, what you think the property would sell for today, your mortgage if you have any, what kind of cash flow that you're getting today, and then your mortgage payment if you have one, and then what you bought it for, and what you put into it for renovation. And these just have to be approximate. They don't have to be, super duper accurate. And then just ballpark the date that you bought it. If you can provide those things for me, we will generate this analysis for you, and then we'll just set up a private time for us to get on a conference call together and go through the whole thing. And if you want to have your CPA there or any of your other financial advisors, we're of course happy to share it with them too. So I've got some testimonials. You guys could probably read faster than I can read them to you. So I want to just really turn it over to all of you and see if you've got some other questions I can answer for you.
Yeah, guys, please feel free to send over. We got about 9 minutes here, so we've willing to definitely spend the time to answer your questions.
Oh, you should talk about the accredited investors.
Yeah, so to invest with us, you have to be an accredited investor, and as long as you be one of these three, then you can do so. You do need to have your CPA verifier. We have a third party service that you can also use, and it'll be good for 5 years once that's approved. But if you have a single household income over 200,000 or more in 2 or more recent years, you qualify. If you do not qualify that route, you can go the dual household income route of 300,000 or more. If that doesn't qualify you, then as long as you have investable assets over $1 million that excludes your primary residence, then you qualify. So you only have to meet one of these three criteria, not all three. Clint is asking, and I can answer this, can you invest funds from a retirement account in these funds? Yes, but you need to make sure, you might have, if you have a retirement account at the large brokerages like Schwab, Merrill Lynch, Morgan Stanley, they typically do not allow, or Fidelity, that's another popular one. They don't typically allow investments in private offerings that are not approved on their platform quite yet. So you'd have to roll that into a self-directed IRA company. If you want some referrals, feel free to reach out to me. I can send a list of them to you. You would have to roll those into a self-directed IRA that allows you to invest in alternative investments. Once you do that, then you are free to invest that capital with us.
Absolutely. It's really easy to do. It's not hard.
Yep. Roger, I am in at 100K. Why does my K1 show something less than that amount? So one reason that might show less, Roger, is that inevitably there's fund expenses and admin expenses in which those losses get passed through and onto you as well. So if you receive, let's say, $11,000 in distributions, but it's showing that you actually made less, that means that there's losses that actually were sent through. So what's good is that you theoretically would owe less taxes than what you were actually received in distributions, which is good. So that's typically why it might show less, just because there were fund expenses and admin costs that were passed down to you. Doesn't mean you receive less in distributions. It just means that you're taxed on a lower amount because of those losses. Cynthia, Nick, can you run through again who gets the 11% fixed? Yeah, absolutely. Do we have a slide on that, Lon?
I don't think we do in this one. We'll have to add that back in.
Yeah, so it's a tiered system. So if you are under $100,000 in total assets under management with Ironton Capital across all of our funds, then for the medium-term income fund, you make 11%. If you cross that 100,000 and you're between 100,000 to 499,000, then you are at 11.5%. If you're at 500,000 to 999,000 in assets under management, you go to 12.5%. And then from $1 million to $1 million to $5 million is 12.5%, and then over 13% is a $5 million threshold. Well, these were all really, really good questions, guys. Really appreciate
Absolutely.
your time.
Thank you so much for taking time. And if you want us to do a portfolio review, here's where you can go, irontoncapital.com/review. And we'd be happy to do that for you. Or if you want to set up a time to talk about any other questions, we're happy to help any way that we can.
Yep. Awesome.
Thanks,
Thank
guys.
you, guys.
Have a good evening. Bye.